What's up, guys? Welcome back to another day trading video, and today we're going to get into the simple concept of fair value gaps. You probably heard of it, just as popular as liquidity. We have fair value gaps, and there's actually two kinds. We have an inverse and fair value gap. But today we're gonna learn about inverse. Today's video, we're just gonna show you what it is and to understand it. All right, so the meaning of it, what exactly it means, how to use it, and all that other technical analysis stuff. All right, and then in the next video I'm going to go into the charts, short little video, and teach you how exactly to spot it in order to use it. All right, so let's go on. All right, so firstly, what is a fair value gap? Simple. It is a 3 candlestick pattern. I'm going to show you that shortly in a second. So it's just 3 candlesticks and it's a pattern. So it just, all you need is find 3 candlesticks right here. So we have 3 candles. This is a bullish fair value gap and this is a bearish fair value gap. What does this mean? So you can see right here 3 candles and we have a gap in between these candles right here, from the top of the first candle and from the bottom of the third candle. And in the middle we have pretend this is green, a green candle. So this is essentially a bullish fair value gap. There's a gap in between these, the first and third candles. And for a bearish fair value gap, we have the first candle, the bottom of the first candle, and the top of the third candle. And you can see there's a gap in between those candles. And what's in the middle? That red candle, meaning this is a bearish fair value gap. So let's put bearish and bullish right there. So what does this mean? It means for a bullish, it means there's a lack of sell orders for a bullish fair value gap. There's a lack of sell orders in this area. So price is going to mostly want to come back down to this area, and since there's a lack of sell orders, it's going to come back and bounce off of that area and go up even higher. For a bearish fair value gap, price is going to go back up to that area because there's a lack of buy orders for a bearish fair value gap. So it's going to go back into this area and then drive right straight back down. All right, essentially acting as a retracement tool. It's going to the stock is retracing back into that area and then bouncing off of it, going up higher. That is for a bullish. Price is going to retrace back into that area and bounce all the way down for a bearish. All right, so how can this be used? This is mostly used as a confirmation tool, a confirmation that we're still going up. So if we see a fair value gap on the bullish side with a green candle in the middle, to know if it's bullish or bearish, it has the second candle has to be green, whatever color you use. So if your starter is most likely going to be green. If you're a different one, if you use a different color, then whatever color you use for it to signal as a good stock that it went up, it has the second candle has to be that. And for a bearish, the second candle has to be a red candle to signify that it is a bearish fair value gap. So this is used as confirmation that the stock is going to go more up higher. So if we see this gap, I'm going to trace it, put a box, see this as a gap, and see that how the price is going to go right back down to that area and then climb up even higher. All right, so how do we essentially use this fair value gap? Yes, it's a retracement tool, but how do we use it? Well, we use it in 3 different ways. We use it for confirmation, an entry, or just proper risk management. I'm going to show you all 3 of those. So this is a more further breakdown of how do we use the fair value gap. So you can see for the first candle, it essentially doesn't matter if it's a green or a red, does not matter. For the third candle, doesn't matter as well. What matters is the third candle. It has to be green for in order for it to be a bullish fair value gap. And there has to be a gap in between the first and third candle. It cannot just simply be where like this. Notice how there is no gap in between it. All right, so this is not considered a fair value gap. So there has to be a gap. And we can see for the red that the first candle does not matter. The third candle doesn't matter what kind it is. Green, red, doesn't matter. What matters is the second candle, the candle that's in between the first and third candle. It has to be a red for in order to be a bearish fair value gap. So how do we use this for confirmation and entry or risk management? For a entry, we wait and for price to be brung down back into the stock. Now that we know this is a fair value gap and a lack of, I'm pretty sure, sell orders, then price will go right back up, and that's when we write it. We take a long and boom, able to do that. Or for a bearish, we wait for the stock to go right back up into this area. We know there's a lack of buy orders, so price will go down. That is for an entry. For a confirmation, we just wait until it plays out. We wait for price to go down and then we have confirmation that the stock is going to continue going up. Wait for confirmation for the bearish, exact same thing. We wait for that stock to go down and then wait for it to go down, back down. We wait for it to go up and then back down. Apologies. And that is how we use it for a confirmation, confirming that the stock is going to be bringing up for a bullish and bringing down for a bearish. How do we use this for risk management? Simple. We use this as a protection. All right, say we enter the trade right here and our stop loss is right here. There is a fair value gap, so we know that this fair value gap has to be respected. All right, if it's not respected, then it can go up even lower, and we know that we got stopped out, and it's completely fine. But if we place our stop loss right here at this level, we know that this fair value gap could be respected, could be used as confirmation for the stock to continue going up. So once the stock is bringing down, we wait for it to be bringing back up because it was placed because our stop loss was placed below the fair value gap. So we had protection of our fair value gap. Right, the fair value gap protects us from getting stopped out because the stock should be bringing down and respect this fair value gap, so it should be brought back up. And same thing for a bearish. We see that the stock formed a bearish fair value gap. We placed a sell order right here, and our stop is right here. Thank you so much for watching, guys. If you liked the video, please like, comment, subscribe, and share with all your friends. Please share the account, grow this channel up at JoshTradeWars.com. Well, actually, not .com, chatting. Josh Trade Wars on YouTube or on TikTok. And this is Fair Value Gap. So thank you so much for watching, and I'll see you guys in the next video. Peace.